Alright, now we can look for confirmations on the chart. This is very good. By the way, how's the trade doing? It's already in profit at this point. Overall, this strategy works well in practice and shows an incredible percentage of winning trades. Technical indicators are essential tools that help traders of all sizes predict how stocks, cryptocurrencies, currencies, and other assets will move. In the past month, we have explored some of the popular indicators and patterns. In this video, we will look at the Fisher Transform Indicator, which is a relatively unpopular oscillator. Hey guys, my name is Mary and I'm your personal trader. Subscribe to my YouTube channel to stay updated with the new publications where I show you the world of trading. I reveal all the secrets I have accumulated over many years of practice. What is the Fisher Transform? The Fisher Transform Indicator was created by John F. Ehlers, an academic professional and trader who has written widely. The indicator, which is not very popular in the financial market, is not available in most trading platforms. When applied, the Fisher Transform appears similar to other indicators like the MACD and stochastic oscillator. The indicator has two lines that move up and down. One of the lines is known as a Fisher, while the other one is known as the trigger. The other horizontal lines range between 1.5 and -1.5. Therefore, most traders use it to identify where new trends are forming. They also use it to identify divergences. How to trade with the Fisher indicator? Using the Fisher Transform is relatively easy. First, you need to have a chart that is either trending upwards or downwards. We believe that it is not useful when the price of an asset is ranging. Second, you need to set the indicator well. This means that you should select the periods that you want to use. Most platforms have the default as 9, but you can change it to suit your trading style. I recommend that you leave it unchanged. Finally, in most cases, I recommend that you combine the Fisher Transform with other indicators like the moving averages and parabolic SAR. In the chart, we have applied the Fisher Transform Indicator of the 4-hour chart of the USD and Japanese yen pair. In this example, take note of the blue trend lines. As you can see, the USD and Japanese yen pair started moving lower when the Fisher line and the trigger lines made a bearish reversal. The pair continued to decline until the two lines made a bullish divergence. In the chart, we see that the pair started a bullish trend when the two lines made a crossover. This is shown in the green lines shown below. The third way of trading using the Fisher Transform is to identify divergences. After the USD and Japanese yen pair ended the upward trend, the pair started to consolidate. As this happened, the two lines of the Fisher Transform started to fall. This was the signal that the price would decline. This happened as shown on this image. Finally, you can use the indicator in combination with other indicators. One of the most popular ways is to combine it with the double moving averages. By using this strategy, you identify reversals when the two moving averages lines cross one another. The benefit of combining the two indicators is to avoid false breakouts. A closer look at the Fisher Transform Indicator applied on a chart shows that they have a similar resemblance to the stochastic oscillator as shown on this image. The two indicators have several key differences. The main is how the two are calculated. The calculation of the stochastic oscillator starts with the calculation of %K and %D. The %K is calculated by first subtracting the lowest low from the current close. You then minus the lowest low from the highest high. Finally, you divide the two and multiply by 100. The %D is then calculated as the 3-day SMA of %K. Still, the two indicators are used in the same way. First, you can use the two to identify the oversold and overbought levels. Second, you can use them to follow the trend. The two indicators will mostly rise when the price is rising and fall when the price is falling. Also, you can use their crossovers to identify buying and selling signals. The Fisher Transform Indicator also has a close resemblance to the Relative Strength Index RSI. Yes, the two indicators are used in a similar way. They can be used to find overbought and oversold levels. Further, they can be used to find divergences and in-trend following. Advantages of using the Fisher Transform Indicator. There are two main benefits of the Fisher Transform Indicator. First, it is a relatively easy-to-use indicator. The signals identified by the indicator are relatively easy. Second, that it is relatively easy to use the indicator with other indicators. Third, it is an indicator you can use on both Forex, stocks, indices, and other indicators. Let's now test the strategy in practice on the euro and Japanese yen currency pair. Let's switch to the trading platform and open a long position. To not miss the opportunity for 3 minutes with $300 and for the upward movement. Alright, now we can look for confirmations on the chart. Here I can see 3 confirmations from the Fisher indicator. First, we need the minimum value -2. Currently, the indicator shows -3.21, which signals a buy. Secondly, the stochastic indicator should indicate strong oversold conditions. We have that, oversold at the level of 12, which is quite significant. No, its value has dropped even further to 4. This is maximum oversold territory. There is nowhere lower to go by 0. This is very, very good. By the way, how's the trade doing? It's already in profit. The market is starting to reverse. If we draw Fibonacci levels, we can make an assumption that the price should retrace at least to this point, to this level, and the maximum to this point. Overall, this strategy works well in practice and shows an incredible percentage of winning trades. So remember, take notes and confidently use this strategy. If I were trading without this strategy, I would probably open a short position. Here we have a strong downward impulse and the nearest reversal point is significantly lower, at a distant support level. But if you use the right indicators, it's evident that the reversal should happen right now. This is indicated by the oversold condition of the stochastic and very low values of the Fisher indicator. The stochastic was below 9, even dropping at level 4 or even 3. The combination of this and the Fisher indicator told me that the decline had already ended and that an upward movement would follow. There is literally only 1 minute left until the trade expires, and it's already shown a 20 pip profit. I don't know what would need to happen for this trade to end in a loss, so I'll just observe. By the way, a small note about Fisher: it's better not to enter the market when it has just dropped to the value of -2. It's better to wait until it goes even lower, around -2.5 or even -3, then you can confidently open a long position with any amount. The same advice applies to the stochastic. It's better for it to be at its lowest. This way you may miss a few opportunities, but you will save yourself from a large number of losing trades. And now I just have to wait for another 20 seconds. The strategy perfectly handled the situation. Almost all the candles are green and the trade is in profit by 78 pips. I can't imagine what would need to happen for the trade to go into a loss. Well, here are the last 5 seconds and I'm locking in a profit of $276. As you can see, the combination of Fisher and stochastic helps to accurately identify the reversal point. In conclusion, I recommend that you take time in the demo account to come up with the trading strategy. I also advise that you adjust the periods to see how they react with your asset. Thank you for watching. Like and subscribe to the channel. If you want to participate in trading sessions with me and receive signals from me, then subscribe to my Telegram channel. The link is in the description. My name is Mary, and I'm the best trader.